Why? Is my data not working? That is the question. Oh, shoot. Is it? Can I? Hey, good morning, everyone. Oh, nice. Welcome to our Q&A session here. I'm trying to figure out. I think there's a way that I can turn that off. Good to see you. Good to see you. I'm going to see if JP's going to be jumping in here real quick. Right on the equity open, so we're going to take a look at that real quick. But welcome to our Q&A session. As always, reminding of the risk involved in markets. It's about the only thing that we can control is the risk. We are, there's different ways that you can look at markets. One is as a technical trader, as a fundamental trader. We are behaviorists, so if you're new to the profile, still looking to figure that out, what we're really trying to map is we're trying to map human behavior, and specifically how human behavior operates around price and volume, which are the only two indicators that absolutely every market participant looks at. Whether you're a retail trader, you're an institutional trader, a bank, prop firm, what have you. So just a couple welcome introductions. I'm Josh Schuler, the founder of Trade with Profile. Had a movement from knew nothing about trading to getting exposed to the markets while I was going back to school to get some grad work done, and that eventually just led to something that became a hobby into something I can't not think about, and then eventually worked in the industry for on the institutional side, but really love helping others unlock this. Also part of our team, JP, I don't see him yet on the call, but hopefully he'll join us as well. In between the two of us, we've got about 30 years of market experience, specifically looking at markets with these tools. And if you've, our process and what we exist to do is really to help traders develop skill and consistency. Most traders are looking for a consistent profitability. I'm pretty sure, you're all a smart group. You probably know that the idea of a 100% effective approach to markets does not exist. so instead, you're looking at something that you can be consistently profitable with. There is no holy grail in trading, but you can be better than always losing. You can be consistent. And so we've developed a process called our Profile Trading Development Pathway, which is 16 modules of principles that we see exhibited through the auction and express those to help us coalesce around 3 objective focus areas. One is the 4 behaviors observable in every auction. And those 4 behaviors are a beginning, a move, a test, and a directional move. I'm sorry, beginning, rest, which is after the move has happened, a test, and another directional move. The 4 questions to ask before entering a trade and how to answer them, that's what's the opportunity? What am I willing to risk for that opportunity? What would tell me that I'm right? What would tell me that I'm wrong? And then 4 stages of auction competency. Stage 1 is I don't know what I don't know. That's an unconscious incompetence. Stage 4 is a conscious competence. So you know what you know so well that you don't even really have to think about it that much. And getting some alerts here. So it looks like Crude is pushing. What's going on with my data feed? Let's look at this real quick. Oh yeah, cleaning up those single prints. Hang on a second. I've been waiting for this. And I'll explain what I'm looking for here in just a second. How about that? Was that 51? One second here. We gotta eat. Okay, excellent. So we find that there's consistent profitability. How you get to that is through the understanding of all of these, where these all overlap. That's kind of the center of where we have found over time consistent profitability to exist. So with that, that's just kind of some light introduction. Our plan today was to do a couple different things. One was to talk about the profile and any questions that you have with respect to the profile and how we use that to express opportunity. And then second to that, we would just field any questions that you have. I know I've got some questions around different ways that we use the profile. I've got one question around volume profile versus market profile. What's the difference? So if there's a specific question that you want to make sure we cover, go ahead. You can use the Q&A or the chat we see either one of those, we'll make sure we cover those. But I did want to talk about the Fed. You might have noticed this week we've had a lot of conversation around Fed Chairman Powell, and the idea of would the markets raise rates or cut rates, and what's at play there? How's that going to work, and what does that fundamentally mean? So here's my quick read on all of this and how this applies to us in terms of behavior around the auctions. Two things. So as I perceive what's happening right now in the U.S. administration, what they're attempting to do is they're attempting to repatriate this whole America First idea. Requires that if a company is going to do a lot of business in the United States, it has to have cheap funding. Okay, so cheap funding is based on interest rates, and what can a company borrow money and finance operations? Well, the Federal Reserve, if you go back to the 1970s and the act that was established by Congress to give two primary objectives of the Fed, one is inflation and the other is unemployment. Well, so we have, as an economy, reached something that we would call full employment, meaning that there's basically a job for everybody who wants one. Now, quality of job, wages, and all that stuff, that's a different issue. But the question is, what's the unemployment levels? That's why they always look at non-farm payrolls. What's the unemployment level look like? The second is inflation. The key tool that the Fed has to influence this is interest rates. And when the economy needs a boost, they will often push it in a direction by lowering rates to make things cheaper, and then when things start to stabilize, they'll raise rates to kind of slow down and keep it from overcooking. Okay, this is the deal. So we came into this year with the expectation that we were actually going to raise rates a couple times in 2019. We're now expecting 100% expectation of cutting rates in July 31st FOMC meeting, potentially another rate cut by the end of the year. And if you don't have it on your radar or don't look at this, there is a great tool that the Chicago Mercantile Exchange has called the CME FedWatch tool. So I'm going to just pull this over here real quick, and we can take a look at this. Oh, way too low. Let me just add this as a tab. Here we go. So you can see the URL right here, but you can just Google CME FedWatch tool. This is a great tool that you can use. Tells you when the next Fed meeting is. It also tells you what is the probability and expectation of a rate cut or hike. Basically, what's the target rate that they're looking for at the next meeting. So this, when people say, hey, we're expecting an increase or a cut or something like that, this is the tool to go to find that. Right. So I will tell you, just observing how the auction has behaved this year, that there have been two levers that have been pulling the auction that have caused market movement consistently. And those have been what's going to happen with China trade and what's going to be the Fed. All right. And if you want to predict that something's going to move the market, it's going to be what's happening with China trade and what's going to happen with the Fed. Well, right now, the China trade is kind of on the sidelines. And now all the focus is on the Fed because there's been enough disruption to global trade and expectations. We're already starting to see softening data in Q1 and Q2 that this is putting pressure on the Fed. Now, my wildly conspiratorial perspective on this is that the Trump administration is actually using China as as a wag the dog, quote unquote, to force the Fed to cut rates because the Trump administration needs lower rates to fund growth in the United States while it renegotiates global trade stuff. So I don't personally, I think it's reckless. I wouldn't do it, but I can recognize the effectiveness of what they're attempting to do. And that's the mechanism. So what you can expect is that we go through the rest of 2019 into an election year. And as Bill Clinton famously said, it's the economy stupid, meaning that most voters are not perceptive enough to understand the nuance of policy, and so they look at their pocketbook. that you can expect that that the Trump administration will continue to use China or Europe or Mexico or whoever they can to put, because we're in a strong economic position, to shake and cause worry so that the Fed will then be forced to act and lower rates to continue to boost up the markets and sail into 2020 to get reelected. And I'm imagining that this game is going to continue to play for the next year or so until we get through the next election. And then who knows, where it happens. I don't know how long it can last. That's above my pay grade. I don't know if we get past 2020 and then kind of the wheels come off once they've won the election. But if we falter somewhere between there, then the Trump administration won't be elected, whether you like Trump or not. Just if the economy falters under his watch, he'll be out. No president that I've ever seen has spent as much time correlating the market to his presidency, which, Republican and Democrats in the past would say that that's really unwise, that the markets don't represent the economy. Even from the fact that since from 2000 till now, there are half as many publicly listed companies as there were. So it's even less representative of what's happening in the economy. And in fact, if you want to really look at like what's going on, just look at the Russell 2000. Okay, so I'm going to pull a longer term chart here. And while all other markets have been making new highs, okay, the Russell 2000 is really in balance. It could go either way. This represents 2,000 companies, right? The Dow represents 30 companies, the Nasdaq represents 100 companies, the S&P's 500. So if you want to, broad, and this is more of real. This isn't the Fortune 100. These are, smaller companies publicly listed that are, they're just kind of trading sideways and have traded sideways for some time. So things aren't as they may appear. I mean, like when we look at the Dow. We see this, massive perspective. Again, remember that this is based on 30 companies. This is not a good indicator of what the overall economy is doing or going to do. So with that, then the question is, okay, so this is going to happen. We're going to have Fed participation in markets. And so the question is then, like, how do we trade that? What do we look for? How do we use that as part of our trading plans? And so I've got an ES chart here, and I just want to go back and look and show you kind of what I do, day to day as I see these type of events and what's going on. So let's just talk most recently. So this week we've had Chairman Powell speaking. And testifying before Congress. Now, the Fed has not raised rates or not cut rates. They have not done that. But everybody believes that they are. In fact, that could be the ultimate screw the dealer, is if they don't, if they leave them as they are, or if they actually raise rates, which if we look at bond markets, the bonds, this could be the interesting, I haven't looked at bonds this morning, but look at what bonds are doing. Bonds are moving lower. This is not lower rates. So bonds move in inverse to rates. So lower bond prices mean higher rates. There could be something going on here. Also, if we look at gold, okay, gold has been breaking out of a long-term 6-year range and is holding higher prices. So this, not all as we assume, but again, we got to make decisions day to day. So how do we use these in our trading plan? So one, I've got a couple different references just recently, and then I want to go back to the last FOMC meeting and look at that. So you can see there's a gap that we have here. This was actually from, oh, there's JP. Hang on a second, let me.
Good morning.
Sorry, dude. I was on a foaming rant.
No, that's all right. I was listening away. It was great.
So here's a gap. And when we talk about gaps, we talk about from one real-time range to another. That means that the market has absolutely accepted prices in a totally different atmosphere, and that represents directional conviction. And so we lean on that until we see that traded back through. That actually holds control. So there's actually a gap here, right, from here to here, from 27 or 29.85 to 29.88, that was before the beginning of the testimony on Tuesday. So I'm sorry, on Wednesday, and a couple different things that happened that were all Powell related. So first, he spoke Tuesday, Wednesday, and Thursday. Tuesday, we actually opened, and you can see in Globex trade, we were below a key high volume area. In fact, in our plan, we had noticed that there was a build out in the profile right here at this 29.78 area. And through Powell's conversation, the market pushed above, because the market really, these prices really like low rates. Okay, so accommodating policy moved above this. So that's the first thing that we looked at this week in terms of our plan, is that an auction, when it comes back through a high volume area and seems to push away and then comes back through it again, that's basically saying that the sellers that were present here are not strong enough to hold this level, and then they will move over to the buyers. Anytime we see a peak in the profile, in the volume profile specifically, that represents buyers and sellers. That was an area of price where both buyers and sellers were active. Okay, so and that's why when we look at those prices as prices to make decisions around, because once approaching them, when we approach them again, we look for those prior participants to re-engage. There may be resting stop orders there. There may be some activity they're willing to do. If they're willing to do it price there, then again. So the first clue today around this week around Fed was the fact that we had a level from last week that was significant, looked early like we were going to push below that, and then came back above and accepted and closed above that level. So that was kind of the first Fed line of defense this week. Then the second was that Powell's comments got leaked before the open on Wednesday, before testimony in Congress, and then we got the gap. Okay, so here's the gap. And then the auction actually held the gap. So during the session, we actually extended the IB low. So there were sellers that stepped in during the session, and yet we held the gap. So when you hold the gap like that, that's still telling us that Fed-induced momentum is in control. We started to build out an area of volume up here. Yesterday, we attempted to push below that build out area of volume and closed back above it. So they're still holding this Fed-induced rally. So, and then today, we can see we pushed higher in Europe and Asia. We're holding above yesterday's range so far. So that even though Powell's not speaking, this Fed-induced rally is still happening. And so now we have references to the downside that we can watch. So one is 3003. There's an area of volume here. That was yesterday's point of control. The other one is here at 29.97. That was the key level, and a way to mark this in your plan is this is the key level that held during Powell's testimony before Congress. And it's completely appropriate to add that to your trading plan and say, okay, that's a level that I'm gonna hold. And here's why we add these to your trading plan. Because it's remarkable how often we come back to these prices. And this is the next thing that I want to show you is we're going to go back and we're going to look at so on this platform here, these blue lines represent a week of trade. Okay, so this day right here was the June FOMC meeting. Okay, and that was when the Fed said, and this is the party line that Powell has continued to use. He said, we will act appropriate. We see some softening. We don't see need to act, but we will act to what's the term that he used? To continue to support the expansion. That's the exact phrases that he uses. I mean, I got such a man crush on Jerome Powell. Like, the dude is like, like, just even watch his testimony before Congress. He just stays so on script, and because he understands, maybe unlike some others in our administration, how what he says can impact markets. So very keeping his cards close. So this was the first place where they thought, there might be accommodating monetary policy. We pushed higher. Okay. Then the market failed and came back and held. Well, guess where it held? Right back at, and in fact was back to this price. And then on this day, the 27th, Powell spoke again. And he reiterated the same things. We will do what is necessary. We will act to support the expansion. This 29.25, 28 level is a huge level to watch and carry forward even the rest of the year. Because this is the first instance where we heard the Fed put into words, hey, we could look to actually cut rates. So everything that's happened since then has been in keeping with and in follow through to this idea of them cutting rates. So look, now, here's the other reason that we put this in our trading plan. Have they cut rates? Do they? Have they cut rates? They have not. There's not been a rate cut. So if we've moved from 29.25 higher and there's been no rate cut, so what happens on July 31st when we get the cut that everybody expected? Okay, hopefully this is going to help you be a more nuanced trader. Because this is what, if you've ever heard the term pricing in activity, see, opportunity happens at the turn and early. By the time that everybody else can identify it, the move is over. So what we're seeing here is a route. We're basically pricing in the rate cut. So, and it's very possible that we will continue to rally up to the 31st and then get the cut and then sell. So, there is some reasonable expectation around the idea of sell the news, meaning once the news is actually released, that's the time to get out, because everybody traded up till that point on the expectation of it. And here we're actually seeing that. I'm showing you a number of different levels that I'm carrying forward in my plan that I continue to reference to say, okay, those are areas that, I'm going to be watching, the rest of the year. So we got this 29.78 area, we got this 29.25 area. Those are key areas to watch as the auction goes forward the rest of the year. Okay, so that's a way that we use and mark those events. So anytime that you see, an FOMC meeting, I'll typically go back and I'll mark the scene of the crime of wherever the program's kicked in and the move started, and then mark that and carry it forward. And that movement is in control until the point that we trade through and accept in the opposite direction. So you can kind of, as you're building your plan, you can go, okay, well that's still holding influence on the auction until it's not. Much like a gap, these are Fed-induced gaps, but much like a gap or some other type of economic report. Okay. Any questions around that? A similar dynamic, just a non-correlated market to look at this would be, we had a grain report yesterday. So let me pull up soybeans. So we had a WASDA report yesterday. We're almost at 9:30, JP. We're almost there.
Almost. Let's get that 9:30, get it over the hump.
Let's get that 9:30.
Then the race can really start.
Then it can really start. So see this significant spike in price right there. You can also see the spike in volume. That was the release of a WASDA report, World Agricultural Supply and Demand. report. Now, JP and I will tell you, we don't make any bets on reports like that at all. We do not front run the reports. We don't, look at economic reports to say, oh, I believe the market's going to do this or that based on the report. We don't do that at all. The only hints that we get potentially are where is price relative to value on multiple time frames. That can give a clue. And why we say 930 is because if I go to a longer time frame, I've got a significant price reference at 930, a prior area of balance and acceptance. And so, long soybeans, because after that report, they closed above the scene of where that report was here at 912.25. So as long as we continue to accept above 912.25, guess what? The buyers after that report are in control, and then we're targeting that prior reference, which is 930.
And if we can get back above.
And if we can get back above 930.
Yeah. So this all happened because we had many instances up there, and of price trading up to that level and backing away from it multiple times, and then on the next go up, which happened back in June, got rejected again. Mm-hmm. Now we're 923.75. So we're pushing that level again. And more importantly is not just the level itself, but where can this thing go after it breaks, makes a clean break at this level? And we've got just
big levels.
Yeah, big. We have lots of stuff to clean up above. So
yeah, because soybeans have been just hammered last year. So we've got 972 is kind of the long-term level that we're watching.
Yep.
If they can break above this. And this brings into, so the question that was asked prior about volume profile versus market profile. So this, these histograms are volume profile, and we look at those across multiple time frames. Meaning, we'll look at what's a profile look like. This one's a 5-year. The composite on the right is 5 years of data. Okay, the smaller profiles are 1 month. So I can kind of see where's value developing on a monthly time frame. Where's it looking over longer window like that. When you find a price level that stacks up across multiple time frames, whether it's a 1 year look, a 1 week, a 1 month, 1 day, that becomes a significant level, and that's where really, really big moves happen. And we use volume profile to help us determine areas of interest, where are the larger magnets in the auction, and prices like 972, it's not going to be in play today. I mean, for one, it's outside the price limits. Like, we physically can't trade there today. However, as long as we continue to accept above, 912, get above 930, it gets more possible. That longer term magnet starts to pull us, and we can that's how we can start to be more predictive in where is the ultimate direction of the auction going. That's volume profile. It helps us determine levels of interest. It also helps us set expectation of how is the auction likely to behave when we get into that price. Market profile graphic, and why we continue to use the market profile graphic, is that helps us discern the probability of control and interaction with those price levels on a given day. And that way we can use open types and day types to help us discern that. So like right now, this is what we would call an open auction outside of range open type in the ES, and which is a directionally convicted open type. It's direction to the upside. And then depending on how we extend this range could set expectation for the rest of the day. If we extend the initial balance higher, that could set the stage for a trend day the rest of the day up towards that 3018 level. If we extend the initial balance lower, we could see a normal lower day. We could see a normal variation lower day back towards 2996. So at this point, we're just kind of waiting to see. I'm expecting some significant extension because right now we've done, and now we're just into B period, but we've only done 17 ticks in the ES that we average 38. So we're about half of what we'd expect in the first hour. Volume is also really low, very little participation at the moment. So that, Thomas, to your question around like how to use different open types. So that's how we use that. When you're building your plan, you're starting with the levels built on the volume profile, looking across multiple time frames. And the time frames we tend to look at is we look at, where significant levels for the last week, or rolling, 7 days, where's significant levels for the last 30 days, where are we relative to those? And then, then I say, okay, what type of open is it looking like? What type of day is it that I can, have a probability to hit that? I mean, right now, if we get IB low extension, so if we take out the IB low in the ES, I would say that there's a very, very good chance that we'll see 3003. That would be like target 1 on extension lower. Target 2 would be 2996. All completely reasonable targets based on the fact that that's within the expected range of the product, and those are nearby magnets. Same to be said for 3019. That's a level. Now this is a level that's generated whenever you have a market that's trading new territory, meaning we've never traded those prices before. We do use Fibonacci numbers for that. We only use I hate Fibonacci numbers, but we use Fibonacci numbers because that's what everybody else uses. So that's what the desks use, because that's about the best thing that we can do to project potential extensions. But that is within probability that we could get to 3020 on IB high extension this afternoon, which would be a trend day higher. So we're just gonna have to wait and see which one we get. Let's see, let's go to look at crude oil. Crude oil open auction in range could potentially be an open auction reverse or open rejection reverse, because it opens, rejects out of the prior range, comes back into that. I'd say if we get IB high extension here, 60.79 is the level that we're looking to be in play. If they get IB low extension, we're looking for 59.70 and 59.50. Good question. Okay, don't understand today's posture with price in the 20-day. Price looks more than the ATR expected range on the quick sheet. So what Chris is referring to is, let me get over here. So one of the ways that we identify opportunity is that we look at the relationship to price and value across multiple time frames. And we generate something here called the quick sheet. So this is a number of products that we look to trade or to monitor. And we don't necessarily trade sector ETFs, but we look at those as kind of a bellwether of what's happening in the rest of the markets. But our core products really are the ones listed up here. So crude oil, you can see this thing says posture, where price is above the 5-day, which is equal to the 20-day. What that means is that the most traded price of the last 5 sessions is 57.83. The most traded price of the last month is 57.83. We're currently trading 60.52. So the price is above value. And then we're expecting, based on option prices, we're expecting $1.10 in range for the day. And so far, from 60.75, so $1.10 from, and how you measure that is the Globex high. So 60.75, $1.10 would get us to 59, or dollar would get us to 59.75, and then so 59.60-ish would get us to the expected range. The market's expecting that we're going to stay within that price range. Certainly could get beyond that. And when I say expecting that, it's about a 68 to 70% probability we'll stay inside of those prices. We would have to trade, above the high here, or below this to exceed that expectation. And the ways that we use that information is we go and say, okay, well then what prices are reasonable to look at that are within that expected range? That can help set the playground that you're looking for the day. So that puts all of these prices within reasonable expectation of being touched today. Obviously, the 59.45 would be a little bit outside of that, but the 59.70 would totally be inside of that, and very possible. When we just got on the call, what I was looking for, and I can click these off now because they've been used, but we had an inventory report the other day, And you can see there's a single print, an area here in the profile that we only traded in one 30-minute period. We cleaned up some of those, that excess yesterday, and then we got another one of those zones on the open. And so I had some shorts from yesterday that I was looking to target these, and so we got those covered, and now we're looking to do the next thing. So good question. Let's see. Oh, did you see that, Scott, what that average IB for the ES is? Yeah. About 3840 ticks. About 3840 ticks. Got it. Sweet. Yeah. So that's a little bit about the Fed. That was some question about market profile versus volume profile. And you know, other than that, it is Friday. It's summer trading. When we talk about summer trading, let me just kind of pull up what we mean by that in a way that we can see this. Is the right chart here. Hang on a second.
While Josh is pulling that up, if anybody has any questions, go ahead and just pop them in the chat.
So notice, like here's May. This line here represents the average volume in the product, and you can notice that since mid-May that we've just been in decline on the average volume. So as the markets have been going higher, we've been running out of participants, and to the point that now average volume right now is about 60% of where it was, if I had to guess, about 60% of where it was in May. So that is a, and you can even see like from where we were from last October. I mean, that was even, so we're about half of the volume right now of what we were doing last fall. But if you can look at where we were from last summer, we're about with what we'd expect. And this is pretty typical for summer trading, is that we have less participation. We can have some kind of anemic trade from middle of May into the end of July, where like we're getting ready to have earnings season is about to come out. We'll have that July FOMC meeting, and then August and September we'll start to see some volume pick back up, and as well as some volatility. But what it does mean is that ranges start to contract. So what you see intraday in terms of ranges and opportunity, there's less. The NASDAQ right now is expecting 83 points. Earlier this year, we were expecting 170 points. So there's a whole bunch of different opportunity. And this goes to, nobody's asked this for a while, but it makes me think of this question that I've had before, is, like what should I expect? What's setting a goal for P&L on a given day? Like there are traders that'll go, well, I got to make $200 a day, or I got to make $1,000 a day, or well, you make what the market gives you. like that's what you make, is you make what the market gives you. And what opportunity exists. Some days there's more opportunity than others. So what's a better place to say is, what percentage of the opportunity was I able to capture? That's the
we take it one step further and just what's available to you.
Yeah.
I mean, because not all days are great. We don't have the range, and in some, if you think, let's just say you have, to Josh's point, let's say you have ranges right now on the ES, or excuse me, the NASDAQ are about 110 a day. It's been flatlined since about March. Yep. Give or take probably 10 or 20 points. But let's say we have a 50-point range in the NASDAQ, and your goal is 20 points a day. You're at 50, with 50 points in range, that's going to be really difficult to get 20 out of there. Yep. Now you can, I'm not saying you can't, but it's going to be difficult. So, a couple things to consider. First, do I have the range? Is the market, offering up that opportunity, I'm with Josh. Don't make $1 goal a day. I don't think that's the right way to go.
Mm-hmm.
So Tony has a question. Tony, you say you look at sell buy program information signals and anticipating market direction? No, I mean, I guess I think I understand your question, but no, I don't. Or we don't. We use volume, but in the profile sense. So, we'll look at order flow, yeah, for sure, but that has nothing to do with seller buy programs. I mean, halftime I don't even know what they use anymore to dictate or to see that stuff.
What, the buy or sell programs?
Yeah. There used to be, what was it called? I don't remember the name of it. You could use it to see when there would be a level that's calculated every day, and you could see the buy sell programs that you figured that if it got to that level, it would go ahead and start triggering buy sell programs. I can't remember. There's all kinds of stuff like that around. We know what's pre-um? Tony, can you tell us what that means?
Is that a Twitter handle?
I guess, I don't know. All right, so Milton has a question. So Tony, if
the mechanics that I'm looking at right now that I'm seeing, if you're interested in what algorithms are doing and what the buy and sell programs are, what prices they're interacting around, do some work looking at volume weighted average price, and even so Brian Shannon at Alpha Trends, he's down the road in Denver from me, has looked at anchored VWAP. And so anchored VWAP looks at the volume weighted average price from the origination of a move, which we look at profiles in a similar vein, where for example, so there's profiles that you can do that are time frame based profiles, and that's the easiest way to get started, especially if you're looking at volume profile, would be to say, okay, well, all of these profiles that you see here on this chart are all time based. This one on the far right is 30 days. The one on the far left, I believe, is 180 days. And then you've got a monthly profile inside of that. But like, let's say, for example, I wanted to see a profile for this entire move right here. Okay. So the way that I would do that is that I would go and bring in, and you can do this in, well, it's actually easier here in Window Trader, I think. Let me show you this. I think it heard me. No, didn't like that. Hello.
Milton, we're going to get to your question, by the way, as we wait for Window Trader Blue to open. It's Friday. It's had a long week.
It's been run like crazy. Well, I've got it running on Photon, so I've got it in another place. But
okay.
Man, it really.
Well, what that's doing, I'm going to answer your question, Milton.
Answer that question.
It says, from my friend Dorian in Bolivia, who is too shy to ask. She shouldn't be too shy. For example, what is the most common pattern in market profile or volume profile? I guess honestly, I'd like to have a little. What's that?
Balance.
Yeah, balance. I mean, I just want to make sure I'm answering the question correctly by understanding what he means by pattern. But I would agree with Josh. We have balance, and then we have breakout, which the breakout's not a pattern. It's just it's a reaction to balance.
Yeah, the pattern is that a complete auction is where you have unfair lows, unfair highs, point of control right in the middle. That is the most consistent pattern.
Yeah, and let's break it down to the simplest form. And by the way, this is a great question. And if Dorian was in here, is she Dorian in here? Let's check it out. Dorian, there you are. Don't be afraid to ask us questions. There's no dumb questions. This is a great, actually, this is one of the best questions we've had. So let's, Josh and I have been doing this for a long time. So let's be real, guys. There's only a few different types of trades out there in the world. And to keep it really simple, we have breakout trades, we have reversal trades, and we have trend continuation trades. Okay. And those are known as pullbacks. What we use the profile for is to determine, where, there's 4 questions. And I'm not going to go through those 4 questions right now, but with 4 questions you have to ask yourself before a trade. And we use the profile to help us with those 4 questions to determine, do we have a trade and is it valid trade? And those are really based on those types of trade types. Actually 3 types. There's 4, but I'm not going to give you the last one because it's more gambling than anything. It's called knife catching. But what it does is I guess you could say they're some patterns. I mean, we have the pattern where we have consolidation or we have balance and we break from balance, and then that would be a go with trade or a breakout trade, and then we have or go with trade depending on how you're going to trade it. If that pulls back to balance, then you could go with that trade then again, which would be a pullback trade. Or if we're extended, we're looking for a reversal trade. Okay, and so that's what we use the profile for. Okay, the most common pattern, yes, definitely balance. If you understand how markets work, they balance and then they auction away from balance and they test. And then when they test, they either find more balance or they actually return back to where? A place where business has done before, which is a balance area. Yeah. And once you understand how markets actually fluctuate and they breathe, right? Markets breathe. I look at them as a living, breathing thing because there's people behind them, right? So when they balance, they're resting, they're like sleeping, and then you wake the giant up and then boom, they go. All right. And then we have to determine, are they going to continue to go? Just like what we saw that move the other day, that thing wasn't coming back.
Yep.
All right. We totally engulfed and then went ahead and continued up. That's not, there was no rest, there was no pullback, there was no reversal in there. That was just a straight up move. Now we have rested since then. All right. And now, here we are, we're still today on Friday, we're still resting. At this point, that suggests, I always use the word suggest because it suggests that we could have more upside, to this market. Yep. Now, Josh was talking about, and he was covering a very good topic coming in about interest rates. There's a stat that I was reading this morning, and that stat was on interest rates, and I will get that stat for you. Let me grab my article here. Sorry about that. And I think it's an important stat. If the, people are just, well, they try to be junior economists here when we're getting into interest rates and where the bonds are and where the Fed fund rates are and stuff like that. None of us are economists in here that I'm aware of. I'm not, Josh is not, we're traders. Yeah. But I will say this.
I read The Economist.
I read it too. So that's about all I do with it. When you're talking about Feds cutting rates, can they do it? Yeah. And how will the market react? Well, the last 17 times they've done that, the market has been up all 17 times, a year later. Yeah. So it's a pretty good indication that the market doesn't care at this point. Yep. Okay. So Josh was talking about being baked in. It's already baked in. All right. This thing's, if they cut rates again, I don't think that's going to stop the market. It's not going to turn around. So why do I say that? I'm not going to trade that, and neither are you. At least you shouldn't. Okay, we're going to trade what I just talked about on the charts, which is we're looking for areas for our trades. You have to define your trade. Milton or Dorian, more importantly, if your trade is a breakout trade, then you're looking for balance areas. And you're looking for how to establish yourself inside those balance areas, or once they break out or when they're breaking out. That's your trade. You don't care about what the Fed's doing. However, if you have a reversal trade, like Josh says, so let's say this thing moves up, and we have that level marked where Uncle Jerome, we call him Jerome Powell, where he started speaking and where we broke out from that area. Let's say you have a reversal trade. That could be a great target for you because there's a great chance they're going to come down and visit that area again.
Yep.
Or we have another balance area that we have as a target coming back down. So, honestly, that's a great question, and I'm glad you asked it, even though it was through Milton, but it was a great question. Josh, you want to add to anything?
Yeah, I would just say this is what it looks like. Okay, and this goes back to those 4 behaviors that we talked about are exhibitable in every auction. Is that auctions, like, they move, so that they make a start, and once they've made a start, then what we're looking for is some participant to come in and shut off the auction, and shut off that directional move. Now, this traps a lot of traders because they think that this first move is the turn, and it almost never is. It almost never is. So all of this is just, first this could be profit taking. This is just the first, kind of wiggle. If you see it start to move again higher again, and then it fails again, now we've shut off, and we've gone from a move into the second part, or rest or balancing. And so that then we determine some type of range that we'll trade across that develops some accepted price that the auction goes back and forth across. Now, in this case, because you've come from this way, what the profile looks like is it looks like this. Or, this is what people will say, like a P formation, meaning that it's got excess to the downside. It doesn't really have excess to the upside. And so that's why, JP says it can suggest higher prices, is that as long as you maintain this area.
Josh, are you drawing on something? Because we don't see that.
Can you not see it?
No, we're seeing your 12 charts.
Well, that's weird. You see the charts, but you don't see.
Yeah, I see just 12 charts.
Thanks for the feedback. Can you see that pin right there?
Nope.
No.
Maybe stop sharing and reshare.
Yeah, let me stop sharing and reshare.
Thomas, I see your question. Are there any suggestions about where to learn more about the open types and expectations for the day? Yeah, right here, actually. I would say that the pathway is probably going to be your best bet. It goes into depth on all of that stuff. And Josh will talk about that here at the end of the call.
Oh man, Zoom is the call. So,
yeah, we're still seeing the.
Yeah, it's hung up. You're still seeing the 12 charts?
Uh-huh.
Yeah, it's hung up. So, yeah, thanks for hanging out with us, guys. I'm sorry I couldn't show you some other stuff. We just had some technology problems here. I'm trying to do too much with this machine. I'm going to upgrade.
So I guess before we end here, has anybody got any other questions we can answer?
Yeah, we could probably do one more.
Yeah.
We just can't give you any visual aids.
Yeah.
That's the only downside.
Sorry about that.
Yeah. Kind of bummed by that.
So why don't you talk to Thomas and the gang about the pathways? I think, Thomas's question about open types and expectations for the day. I think the pathways is I personally, it's brilliant. I mean, when I learned profile, first of all, when I learned trading, it was on the desk, and then that really wasn't the way we're trading today. And when I started learning on my own away from the desk, it was totally different, and you just had to find things and figure things out and get kicked in the teeth a few times, well, more than a few times. And then when I learned profile, it was the most crude way of learning that you could possibly imagine. The the pathway series is, if I would have had that, I would cut many years off my learning experience. And I'm not just saying that because it's our pathway. It's the best out there. And I'm going to even stick it on Josh here and say that it rivals anything that Dalton's ever done. So,
well, that's the goal.
Yeah, well, it
up.
does. I mean, it really does. I mean, it's just tremendous.
And I have high respect for Jim.
Yeah, I do too. But I mean,
and but the challenge with trading in the way the mentality of the industry has often been, you either figure it out or you go home. So there's a lot of impetus on the individual trader that part of you sticking it out until you figure it out is part of the development process. Can that be effective? It can be effective in that it sorts out those who are going to have enough resilience to actually weather it.
yeah.
It's not great in helping people actually succeed. From a development standpoint, if you look at any type of way where you're trying to deliver competence to someone, it doesn't work that way. What you need is a systematic process and a way of building understanding that you can actually put into practice. And how do you do that? But by seeing that put in practice. So what we do is we spend time looking at 16 core principles in the auction, and then we look at, okay, how can we actually apply that today looking for a trade? Because it's all well and good to think about a concept in the auction, but if I don't generate a trade out of that or an idea or something I'm looking for, then it's not valuable. It doesn't lead to anything. So that's the most direct way. I mean, Thomas, I could point you in a lot of different books that you could go read. I could even send you, where I started with profiling was a manual that I got from the Chicago Board of Trade on the profile. I will tell you that there's some parts of that 400-page manual that are still relevant, and there's some parts of that manual that are not relevant. And the problem is you don't know which ones. So, which was the challenge I had too, is that I was, going through all this thing and I was asking people about the liquidity data bank, and they're like, oh yeah, nobody's used that in like 20 years. Oh, so there's like a whole section on that. What do I do with that information? So
that's funny.
And
that's a beast, by the way. That manual, and it is highly technical. Guys, listen, in trading, if you're highly technical, and I mean that not in we got so many moving averages and all this kind of stuff. I mean, in your thinking and stuff like this, you got to keep it simple, man. Some of the best traders I've ever met in my life have kept it super simple. And what you're going to learn, it boils down to two things: price and volume.
Yeah. Yep. So
if you go ahead.
If anybody wants to look more at day types and open types, we each week. So our process is 16 weeks. But taking you systematically through all of the auction structures, the key principles around that, and then putting that into actual trade setups that we look for and execute on and exemplify. But each week we cover either an open type or a day type, and then how do we use that information to place the trade. So I just recommend jumping in for a week with us if you haven't yet, and experiencing it and seeing if it's for you. We'll give you a free week to spend time with us and go from there. All right, it's 8:30 my time, 10:30 Eastern. Time to get into the weekend. I'm out of the office next week. Going to be spending time at a family reunion, and so no Q&A next week. But we'll be back the week after that, and we'll be into earnings season, so that will impact the indexes. We've got Robert Mueller testimony before Congress. Not really sure how much that's going to impact anything. Really, just like we said at the start here, the Fed, don't fight the Fed, but know where there are prices to watch that could show that Fed influence is waning. That's a key takeaway, is that there are prices where that influence is waning, and knowing where those are is really, really helpful. And I hope that helped you today. Thanks for spending time with us. Thanks for the questions. JP, thanks as always, buddy.
Yep. Take care, guys.
We'll talk to you guys later.
All right. See ya. Yep.